Hello, everyone. I'm Haydn Zeis, your host, and I want to welcome you to the Raising Returns Real Estate Podcast, where each one of our guests provide you with valuable knowledge from their unique take on real estate investing. Like I have said before, our purpose is to provide you with tangible information that you can use in your own real estate investing career. One of the best things about real estate is that there's not just one single way to be successful. And today's guest, CJ Estel, he is a rising star in real estate right now. He is the owner of You Pick to Rent, and CJ went from owning no real investment real estate to over 2 million in under 2 years. CJ, thanks so much for being on the show.
Thank you for having me.
Hey man, so let's just jump right into it. So tell me and our audience a little bit about yourself and how you ended up getting into this crazy world of real estate.
I actually tried a couple of attempts that were not nearly as successful as the one that I'm dealing with now. In college, I actually tried to rent a house and sublease it out to other college students, and didn't know much about business and didn't know much about what I needed to do as a landlord. And as you can imagine, trying to corral a handful of college students is probably a little bit of a difficult task when you're first getting started.
I don't. You mean you had holes in your walls and beer kegs laying everywhere?
Yeah, it had a lot of learning experiences for me. One of which was the person that I was renting from with the right to sublet had actually lost their job and was living off of the income that we were paying him in rent and not paying the mortgage. So um, we'll just say that House Golf stopped using putters when we got foreclosure notices, which is probably something. Maybe we'll edit that out. So that
Nah,
was my
it's
first
fine.
attempt. That was my first attempt. So we ended up having to leave that place and rented myself for a number of years. Ran my own business in IT consulting. And the '08 crash kind of crippled my business, almost bankrupted me. Lost everything that I had in savings, had to let all of my employees go. And finally, by 2010, I actually ended up joining the corporate world to kind of bail myself out, and was working in IT for folks there. Over the course of the next year and a half, I really worked on repairing my credit from all of those mistakes, and those mistakes had taught me that the biggest thing that banks are willing to do is only give credit to people who don't need it. I absolutely needed the money. There was nobody willing to give it to me, and as I had found this job and gotten everything paid off, my credit card started going from a $500 limit to, hey, it's up to 1,000, and then I'd just get randomly, hey, it's raised to 5,000. So out of curiosity, I started reaching out to the lenders and the credit card companies and saying, hey, I'm getting ready to do a project or whatever. Is there any way you can raise my limit? And I actually ended up getting to the point where I had about $250,000 of available credit, completely unsecured, which is actually one of the things that truly helped me grow my real estate. Um, so while I was going through that, I actually purchased. I'd gotten back on my feet financially. Everything was looking good. I purchased my first home. It was really rundown home. One of the things I'd heard and read is you want to buy the worst house in the best neighborhood, and this house fit that bill. It was in a neighborhood where most of the homes were between 180 and 220,000. Everything was structurally fine, and it was going to be my first flip. So I was going to house hack it and live in it, and try and fix it up, sell it, and make some money, and move on to something else. And I ended up meeting who is now my wife, and she had 3 kids. So moved them into the house, and it became a home, and not quite a house. So we ended up doing a lot of finishes and things like that just didn't make sense from it as a rental perspective. And ultimately, when we sold it, I didn't have nearly the margins that I would have wanted otherwise, but I still did all right with it. And then we moved down to just outside of Lancaster, Ohio. It's a small commuter town for the most part, and continued working the corporate job. I kind of moved around from a couple of companies, and continued to grow in the professional space and the IT space. And here about 2 years ago, I finally felt like I was back on track with where I'm supposed to be for my age. They say that you should have at least one time your income in retirement accounts by the time you're 35. And my wife and I were able to finally get to that point through very aggressive savings and setting money back. And I started looking closer at all these things that you read, and it still has me retiring somewhere around 65 if I follow all of those things.
Mm-hmm.
And I didn't want that to be my life, so I talked with my wife, and we've kind of hit a financial goal here. We're good on all of our bills. We've got a lot of available credit. What are your thoughts on trying to get into real estate? So she basically gave me her blessing, and we bought our first house. Frankly, I didn't do nearly enough research into it, and didn't understand all of the expenses that go into real estate. It's a lot more than just your principal, interest, taxes, and insurance. And frankly, the amount of money that was coming in, I was actually losing money on that house. And started reading and learning a lot more. Those particular tenants ended up, I had to evict them for non-payment shortly after I'd purchased the home. They trashed it on the way out. And fortunately, the bones of the house were really good, so I was able to raise the rent by more than $400 a month after I'd fixed it up, and it actually cash flows really well now. But that was my first house, and just seeing that extra money come in, even with the situation that I encountered there, really enjoyed. Started the learning process, and definitely wanted to continue going with it. So far, I've been able to do a pretty good job of continuing my growth.
So it sounds like to me you have went to the school of hard knocks when it comes to investing and business in general, and that's something that's a really good thing that investors can come away with. I mean, you've had experiences that some of the newer investors that are jumping into things, they haven't experienced a financial crisis. You've got that experience. Can you tell me a little bit about, from a mindset standpoint, what decisions or do you make, or don't make for that matter, with the crisis and your experiences, from the past?
So the biggest thing that I had in my mind as a failure with my IT consulting company is that I did not have recurring revenue. I had to go out, and it's what I had to go slay a dragon every day. If I didn't go out and sell contracts, sell whatever to do development or whatever we were doing, if I didn't go and do that, we didn't have any money. And it ended up being a very rigid pattern of sell, do, sell, do. And without a stable income flow, it's very hard to project your growth and have that stability. And towards the end, when I started my consulting business in IT, I was in high school, going through college, and I thought I knew it all. And that school of hard knocks definitely taught me that I didn't know it all. And as I was starting to get closer to that crash, I just knew I was working way too hard and way too much for what was left on the plate. And I actually started working with a couple of folks from Action Coach Business Coaching. And they really taught me how to look at the business and work on the business and not in the business. And frankly, it was them that ultimately helped me decide, it's going to be, realize how much work it would take to turn my business around. And realizing that that's kind of the thing that shoved me over the edge after working with them for a couple of years and seeing everything that said, I just need to reset. And having that business knowledge, really has helped me with the real estate endeavor. The thought of recurring revenue and how to safely and conservatively grow your portfolio and realize what those risks are. I definitely took a lot away from those coaching sessions, and highly recommend everybody that gets into this has a mentor or has a coach, because it will help you grow tremendously.
And I mean, like, that's exactly the reason for this podcast, is to be able to educate those who are trying to get into real estate or just haven't even seen the different perspectives of different types of investing. But I want to touch back on what you said. I always hear people say, oh my gosh, there's a subscription for everything now. And I laugh because I think to myself, well, yeah, reoccurring revenue has been around forever. everybody pays their mortgage or has paid rent. That's a subscription. So, and the beauty of real estate is that reoccurring revenue. So now I want to get into a little bit more about the types of deals you're doing and the strategies you're using to secure those deals, because a lot of people, they just maybe don't know how to find a deal, don't know how to analyze it. So can you get into a little bit about where you're finding the deals and the types of deals that you are purchasing?
Yeah, so I think most people are familiar with the MLS, and that's where I had started early in my career. The first three houses that I purchased were off of the MLS. The first one we talked a little bit about already. I bought that. It was, for the most part, a turnkey property. It had a tenant in there. The second house was on the MLS. It had actually been in contract, and there was an issue with the survey where the start point for the pins with the county or the whatever agency wasn't recorded correctly. So there was all kinds of survey work and stuff that had to be done. So the house had fallen out of contract, and I was very fortunate enough to just be in the right place at the right time. It was the first day it had gone back on the MLS, and picked up a really nice cash flowing duplex. Both tenants stayed, and still to this day one of my better properties. The third property that I found, after that second property is when I really started to get into the education side of things. Started hitting bigger pockets, which is a great resource to self-educate and learn, see what other people are doing. And I'd read about this BRRRR strategy, and it's basically the concept of buying, rehabbing the property, renting the property, refinancing the property to get your money back out, and then repeating the process. So I was completely ready to go. I'd read about this. I found this house that was cheap, cheapest house in a bad neighborhood. It ended up being an RA purchase by the end of it, but it was my first rehab, and my prior businesses. Some of the things that I've learned is I have to work on it. And I'm a handy person. I can go in, I can fix stuff up, I can do things. But I knew that I would not be able to aggressively grow a business if I were to do that. So I actually hired a couple of people that I'd known from the past that do construction work, and brought them in, and they fixed up the property. And we knew, we had an inspection on the property, but there was this one corner, the bathroom, we knew we were just going to have to completely gut. It had a lot of water damage, and you couldn't get under the house in that particular area. And when we pulled that bathroom, we discovered that the entire interior of the foundation was crumbling.
Oh,
so we had to jack up the back half of that house and do all kinds of stuff. And we were able to get that fixed. And by the time it was all said and done, I was about $85,000 into the property, and it was worth probably about $80,000. So that was my first BRRRR attempt, and that was largely funded on my home equity line. So pretty heavily leveraged into that property. Contemplated selling it, but didn't think I'd be able to get enough. And I probably, in hindsight, had fixed it up nicer than what I should have for a rental as well. There's a few thousand that probably could have been shaved off, but I was able to get exceptionally high rent for the area. Most two bedrooms in that area are between $650 and $700, and I got $850 a month out of it. So the numbers still worked. It's not my best property, but the numbers still worked on it.
Well, even and that's the beauty of real estate, right? Even if you're not cash flowing, you still have principal pay down, and you still have appreciation, and then all the tax benefits that come with the real estate. So although you might not be cash flowing on that particular property, if it's just a part of your portfolio, that doesn't mean that it's a bad investment. And that's another reason why I love real estate so much.
Yeah, real estate, one of the things my mentor taught me is that time heals most mistakes in real estate. For the reasons that you just mentioned, you get depreciation on your taxes, you get appreciation on your property over time as long as you're taking care of it. You get that principal pay down. Eventually, it'll end up making sense. And that property, it wasn't a huge cash flow. It was still positive on the cash flow side. It just it had tied up a lot of my equity that I had available. And I honestly thought I was going to have to seriously pump the brakes and just kind of ride it out with those properties. Then I ended up having my mentor actually picked up a large portfolio of properties under contract, and he wasn't able to take them all down himself financially. So he asked me if I would be interested in purchasing one through him as a wholesaler. So basically, that ended up the numbers on the property were great.
Can you explain wholesaling real quick, just for the listeners that might not understand it?
Yeah. So somebody who wholesales, typically what you're going to find with a wholesaler is they're gonna do the hard work of finding a property that's not on the MLS. They're going to go around and they're going to look for grass that's overgrown or windows that are boarded up or things like that. And they're going to reach out to those owners. They're going to try and get the property under contract for a very low price. And then what they're going to do is they're going to try to sell that contract. They're not selling the home, but they're selling the contract to somebody else. And as somebody who's doing this BRRRR strategy, typically you're going to find that you want to be in that 70% equity position, or 70% total cost of the ARV, the after repair value, when you're doing a flip. So if you can be at that 70%, you're typically going to be able to find between your cost of the acquisition and all of the repairs. If you're at that 70%, you'll be able to find that you're going to be able to get a lender that's going to do a 80% or a 75% loan to value on that property, and you're going to be able to get all of your money back out of that property and move forward. So this deal was a little different because he had picked up an entire portfolio of properties, and he was basically splitting those off into smaller contracts. So it's not your typical wholesale, but it's definitely a way that some people do things, especially when dealing with other investors. If you take down 20, 30 units in a single transaction, a lot of times most people don't have the liquidity to do that, so they'll get all of that kind of bought as a bundle, and then they'll piecemeal it and sell it off that way, which is what happened in this case.
Well, it's a great strategy to, especially when you're from a liquidity standpoint, you can stay liquid while also obtaining different assets.
And for that property in particular, I bought a house in April, I bought a house in May, I bought a house in late June, and I went to the bank, and they're like, dude, what are you doing? We're not going to give you any money. And then I went to another bank, and they basically said the same thing. And I was like, well, I've got renters in these places, and everything's looking good. They're like, yeah, but you haven't been doing this long enough. We don't trust that those rents are going to stick around, and we're not going to count those towards your income. So your debt to income ratio is just way off because you're carrying all of this on your W-2 job, and we don't have that history yet to know that you're going to be able to pull this off and not just go bankrupt. So I started investigating more investor-friendly lenders, and came across a lender that, frankly, I extremely overpaid on the money. But in real estate, that's one of the things, you can look at the numbers and you can figure out how much you should have back when you look at what your vacancy costs are and your capital expenditures are likely going to be, and figure out what you've got, whether there's HOA fees, all of those expenses, and then you can look at what the income from that property should be. And this was a duplex, and the garage rented separately. I was able to pick it up for $82,000, and it pulls in $1,600 a month.
Oh, wow, that's good.
So I found I did not want to pass on this deal. I had the money down for the 25% that a lot of lenders want to see, but still couldn't get anybody to give me the money. Ended up finally finding a lender to do so. It's a borderline hard money lender, and I paid 5 points for a 7.1% interest rate with pretty aggressive prepayment penalties. So a terrible loan, but it still got closed, and that property still cash flows. It is, what my sheet here. So that property cash flows after considering all expenses over $600 a month.
Another beautiful thing about real estate is eventually you can, you'll get to the point where that loan can probably be refinanced.
Yeah, that principal will get paid down. I actually, with rates as low as they are, I've been looking to kind of see if it makes sense to refinance that right now. It is fortunately on a 30-year note, so a lot of I found the commercial lending tends to be a lot more flexible, and you don't have issues of, can it go into my LLC, can I move it after the fact, or anything like that. It's just not a question. But with those commercial loans, you typically pay a slightly higher interest rate than the residential side. Again, not compared to that property we were just talking about rate, but typical bank lending. So you'll pay typically a little bit higher interest rate, and you're normally looking, maybe not a it's maybe an ARM loan, you know, a 5-1 or a 10-1 or something like that, and it's normally a 20-year term instead of a 30.
Yeah, yeah, and they definitely vary.
Then, you know, you've got a great deal.
Mm-hmm. So, from moving on to the residential side, you just recently had a very attractive commercial office building that you purchased. How'd you come across that? And can you
Yeah,
tell us a
so
little bit about that building? When I visited you a couple weeks ago, I was just admiring the building. It's a beautiful building. It's got a very grand entrance, and there are multiple tenants. You got this in somewhat of a creative fashion.
It was actually a very creative fashion. I'm really thrilled with how
Mm-hmm.
everything went through with it. I had just gotten a place under contract that was a 6-unit residential place, and I did not have the money to close on that place. So I was seeking private lending, which, you know, maybe we can talk about that a little bit later because I don't want to take your whole show on some rabbit holes. But
Yeah, you could spend hours on private lending.
yes, we could. So I basically was hunting money for this other house that I had in contract. It was a 6-unit, and my old office building was this building downtown. And I saw a sign out front, and the phone number had changed from the last time I had seen the sign as far as who to call for renting. So I thought, yeah, gosh, I haven't talked to Rob in a long time, but you know, he might know some private lenders or might even be able to do some private lending himself. I'll give him a call. So I called him and, you know, started talking about the building, told him I'd gotten into real estate, and before I could even ask him about private lending, he's like, "You want to buy my building?" I was like, "Well, maybe let's talk."
You mean getting
So
out there and talking to people you can find deals?
oh, it is absolutely amazing. You know, just let people know what you're doing, and stuff will start to come to you. So I ended up meeting with him. He had moved out of state. After he had moved, his occupancy had dropped pretty substantially at the building. He was down below 50% occupancy in the building. And I said, you know, Rob, I can't buy a building that's losing money. I won't be able to get financing or anything else. So we worked out a pretty creative deal. He had a little bit of equity in the building, and what we worked out was a $600,000 purchase price, and he was going to do a seller second for $150,000. So basically, that would give the bank the 25% down that they need, and I could actually walk into the deal with $0 out of pocket. But it still had to cash flow, and it still had to generate money. And where he was at occupancy wise, it wasn't able to do that. So we actually had about I think it was a 4 or 5 month offer period that the contract was good for. And part of that contract, he gave me an office in the building, and I could help manage the building. And we were able to find a few tenants, start getting people in. We got the occupancy back up to right around 80%. And by the time we had the appraisal and everything came through, you know, with commercial property, it's valued differently than residential property. It's all based on your net operating income. So what money you make after your expenses, not considering any loans that you have on the property. It's kind of a generic way of this is how you value it if everybody paid cash for everything, right? So we'd gotten our net operating income up high enough that the appraisal came back at $855,000 for the building. So
That's
um,
crazy, and that's just very shortly after
yeah,
ownership,
yeah,
and
matter of 2 months.
that right there. I mean, that's a really good example of forced appreciation, where you come in with a plan, you analyze the deal, and then you execute, and you can increase your valuation that quickly.
Yeah, and there's still plenty to do inside this building. Frankly, I think I can throw up our net operating income by probably another 30% with some of the things that I want to do. And then I've also started doing things to cut down the there's multiple sides. You've got your income, and then you've also got your expenses that play into that. And I've been doing a lot to cut down on the expenses. As you look at, you've still got the AEP power credits and stuff like that. If you're putting in LED lighting and things of that nature, it typically has about a 2-year return on investment. So we've been going through updating all of our lighting. We've been putting in thermostats that will allow us to control things and better time them based on activity in the building and things of that nature. So it all comes into play. It's really working on your business and not in your business. Look at the numbers, understand where your money's going, and be able to run those numbers to see if something works. One of the other properties I picked up, and this was again creative financing. I go to as many of the networking groups and things like that as I can. I'm in a group of 30 people, and one of the guys says, "Hey, my neighbor has a storage unit facility, and he's wanting to get rid of it. I don't know much about it, but here's how you can get a hold of him." I'm in a room of 30 people. I was the only person that followed up to that man. And
Jeez.
he was making a heck of a deal on this facility. Well, I guess it depends on how you crunch the numbers. So that particular facility, he had bought it via land contract back in '03 for $160,000. He used about half of the facility for himself. He had a landscaping business, so he'd have all of his plows and stuff in there and all his mowers and stuff, and he had like 7 or 8 crews. And he used about half of the place for himself. It was cheaper to own it via land contract than it was to continue to just pay the rents. And the people that had it didn't want it anymore. So that's kind of how the land contract came to be. So he used about half of it. His family used about a quarter of it and didn't pay anything for it. And the other quarter are people that haven't had their rents raised since before '03. I've got an inherited tenant that has a 10 by 20 foot storage unit for right around $40 a month. So I was able to work out a deal with him. We did an assumption of land contract, so I had no money down in the deal, and I just picked it up for the remainder of what was on the existing contract. So it was $110,000 left in the facility. Right now, it's not generating much revenue because it's only about a quarter filled, and that quarter is about 50 to 75% under market rents. So it's got a lot of work, but the plan for that building, we're putting in a key in, key out system. We're putting in new roofs. We're putting in surveillance cameras. We're putting in better lighting, getting everything painted up, and we're going to take it from a C-class facility to a B-class facility. And by the time it's said and done, I'll be all in for about $150,000, and that property should generate a pretty substantial cash flow. It's going to be between $1,600 and $2,000 a month, based on best guesses of what the figures will fall into. And if I were to choose to refi it out of the existing land contract, the numbers get even better. But once that's all fixed up, the valuation puts it at over $400,000 based on that same cap rate valuation system that they use on commercial properties.
And at that point, this is just the Burr method on steroids, essentially. You take that, do a refi on that, and then guess what? You've got cash to play with to go after your next investments.
Yeah, and that's really kind of been the strategy, is how can I fix these things up and then pull that money back. And on some of these properties, it's not just how do I fix it up and pull it back, it's how do I fix it up, pull it back, and pull out even more than I put into it to keep going. And what's been really, I don't know that I'd recommend this, but I talked a little bit about at the start of the show about how I'd acquired a lot of unsecured credit availability. Those companies send you 0% checks all the time. I have literally written a 0% check to buy a house outright on a credit card and then refinanced it into something else with a construction loan afterwards. So, again, I don't necessarily advocate everybody does it unless you really watch your finances and really watch your numbers, because those rates can get really high if you're not paying attention to them. But if you can get 9, 12, 18, 24 months at 0% with a one-time 3% transaction fee, it can really allow you to scale your real estate really fast before you even have to get to some of the other methods.
Oh, sure. You use 0% financing on different deals, and you can just, like you said, credit cards, it's cheap money. As long as you're responsible with debt, it can be a very great tool to expand your business. Just kind of shifting gears a little bit, I guess. I wanted to, like we were talking about earlier, you've got a lot of experience in the School of Hard Knocks, and right now we're going through somewhat of a economic crisis. I shouldn't say somewhat, we are, with COVID-19. I've had a couple tenants call me and express their concerns. And have you seen that right now with your tenants entering this turbulent time? What do you plan on doing when you might not, April 1st rolls around and you don't have the cash flow?
Well, if you're waiting till April 1st, in my mind, you're already behind the 8 ball. I've been trying to proactively reach out to my tenants, find out who's impacted, find out how they're impacted, and proactively try to work things out with them if they need it. So that's kind of step one in my mind is, get in front of any problem that comes at you, get in front of it as much as you possibly can, so you at least know what variables you're looking at. So my portfolio in particular, I can handle about a 40% vacancy rate before I have to reach into my own pocket. Obviously, with some of the repairs and things like that,
Well, that's a very, very important number. It's like that break even point. Where is that? It's something that all investors should know when they're analyzing, because, like we were talking about, there's more than just your mortgage payment and your real estate taxes. You've got to go and fix different things. You might have a roof leak. You've got a water main break. You've got all of these different things that you have to prepare for. And having those reserves set aside really puts you in a good position when you do have turbulent times. And like we've just been talking about, play with your leverage responsibly and you're going to be okay. This too shall pass. I'm sure of that. So,
and from a timing perspective, I actually am pretty fortunate. I just did a cash out for a pretty significant amount from one of the properties that I had fixed up. It was a 6-unit that more than tripled in value since I bought it.
And
so
that's amazing, because when there's going to be deals that can be found, you're sitting on some cash, so you can use that as a reserve,
so
or you can use it.
And, to date, I've mostly taken that cash and immediately reinvested it into other things. And this COVID kind of hit while that cash is sitting in the bank, so that makes things a little bit more comfortable to try and kind of ride it out. So my worst case estimates for COVID-19, April 1st rent payments are coming in around 50%. My best cases are falling around 70%. I've been looking at a lot of the forums, and the wide variety of that spread kind of comes from people who are able to pay but choose not to because they know that the courts are closed and we can't evict them. So, again, trying to reach out, trying to be proactive, let folks know what the process might look like, how we can work with it. Even if we need to do a reduced rent payment and make things up later in the year, they're not going to get out of their rent. But if I've got good paying tenants, I don't want to evict them for something that's impacting everybody.
Well, sure. And I mean, ultimately, our success as real estate investors is having successful tenants that are living a good life. Because, like you said, if every single person is affected by the same thing, and this virus is something that's unprecedented that we've never seen before, we can only be compassionate. And that's really by a case-by-case basis. Like you said, yeah, are there going to be some people that try to take advantage of it? Probably. But we can look at this on a case-by-case basis and try to find solutions for our tenants. And, I don't know about you, but I've had a couple banks call me just to check on us to see how we're doing and let us know that they have procedures in place in the event that we might not be able to pay a bill. So I think we're all in this together, but I love what you said there. Not calling tenants now, then you're definitely behind the 8 ball. But now I do not want to end things on a bad note. I want to end things on a good note and a positive note. And you've had so much success over the last 2 years. I want to encourage people. You've learned from CJ that you can find deals just by talking to people, telling them what you can do. You can find deals that are off market. It doesn't have to be on market. You can even buy property with zero money down, and you don't have to use traditional financing. Now, out of all of those things, you are using each and every one of them to benefit you and your family and build that generational wealth. Now, can you tell me from an investor perspective your best piece of advice that you'd give our listeners just to raise their returns?
The biggest thing is know your numbers and know your goals. You have to know why you're doing it and how aggressively you want to do it, and make sure that you've got those safety nets. But focus on your numbers. Try to stay at that level and hire out what you can hire out. You're going to make a lot more money in real estate focusing on the real estate than you are going and swinging a hammer yourself.
Well, CJ, I think that is well said, and I really appreciate you being on the show. And to all our listeners, we'll be back next week. Please subscribe if you found this information useful, and share it where you can. Thank you so much.